Hello, everyone, and welcome to today's Technology Tuesday presented by Out of the Box Technology. We're so glad that you've taken time out of your afternoon or your morning, depending on where you are in this great country of ours. We appreciate it. Today, we are going to be talking about the Employee Retention Tax Credit, and this is a really hot topic, but also kind of an unknown advantage that is out there, which is why we're really excited to chat about it today. So a little bit of housekeeping items. My name is Jennifer. I will be your moderator today. I'm on the marketing team here at Out of the Box Technology. And just a few things to let you know about. Today's session is being recorded. So you will all receive a link to this recording a little bit later today. So if there's anything you wanted to revisit or maybe share with a colleague or friend about this information, we're happy to provide that resource to you so that you can spread the word about this amazing benefit. Also, if you have any questions as we're going through the presentation today, go ahead and type those out in the chat, and we'll be sure to address all questions before the end of today's webinar. Just a bit about Out of the Box Technology. If you haven't joined us before, or maybe it's been a little while, we are anything and everything QuickBooks. As an elite QuickBooks solution provider, as recognized by Intuit, we really know all there is to know about all of the QuickBooks family of products, from QuickBooks Desktop to QuickBooks Online and everything in between. Our team is full of certified pro advisors who keep up their certifications year over year to know all the ins and outs about the QuickBooks products. We offer services surrounding data integrity and migration services, bookkeeping, recurring, ongoing, as you need it, and then training, integration, and support surrounding all of those elements. So enough about us. I know you all are here about this topic of the Employee Retention Tax Credit. And so with that, I would like to hand things over to our presenter. Matthew is joining us. He's just about 45 minutes from me here in Southeast Michigan. He's with DA Advisory Group and just really an expert on this topic. And I'm really excited to have him here today to talk about it. So Matthew, I'm going to hand things over to you and let you dive in.
Awesome. All right. I should be sharing now. Can you see my screen, Jennifer?
Yeah, it looks perfect.
Awesome. All right. Well, again, Jennifer and Out of the Box, thank you for having me on your webinar today. Excited to talk about the Employee Retention Credit. As Jennifer mentioned, my name is Matt Abbo. I am partner at ERC Tax Pros, which is an employee retention credit firm. And I am also partner in a CPA firm called DA Advisory Group. And so today we'll be talking about the Employee Retention Credit. What is it? How would someone qualify? And what is the process to submit an application to the IRS for the ERC? All right, so what is the ERC, or Employee Retention Credit? The ERC tax credit, or Employee Retention Credit, is a refundable tax credit offered by the U.S. government to eligible employers who retain their employees during the COVID-19 pandemic. The credit was implemented as part of the CARES Act in 2020 and has since been expanded and extended by subsequent legislations. So initially in 2020, the IRS had rolled out this program, and at that point, there was payroll protection program funding that was out there. And at that time, it was either one or the other. Either you received the PPP funding or you would have received the ERC tax credit. And subsequently, the IRS had amended the rules for the Employee Retention Credit to say that even if you did receive PPP funding, you could also be eligible for the Employee Retention Credit. Now, the Employee Retention Credit is different than the PPP in terms of that it is not a loan. So this is a tax credit, something that you would not have to pay back. I know for the PPP fundings, a lot of people had to submit applications, and although most people didn't have to pay that back initially, it was a loan, and it was a loan that was forgiven. But here we're talking about a tax credit, and so essentially The max credit that you could get is up to $26,000 per employee. I'm sure a lot of you listeners, who have heard about it, might think that it's too good to be true. I know we have a lot of clients that thought it might was a scam, or they just didn't believe that this money was real or out there. But again, it is a COVID relief outlet, similar to the PPP or any other maybe funding that you would have gotten from the government or some other local municipality. And so again, the total credit you could obtain is $26,000 per W-2 employee. Now, so I want to be clear, that's W-2 employee. So any person that you 1099 or you have a contractor for, those payments would not be eligible for a credit. This is an employee that you had on payroll, that you withheld payroll with taxes from, and that you submitted a W-2 to, and they reported that on their personal income taxes. So the question is that $26,000 per employee, how is that determined and how is that calculated? And so this credit is kind of a two-phase type of deal. So the credit takes into consideration W-2 wages in 2020 and W-2 wages in 2021. And so we'll do some quick math to get to the 26,000. So in 2020, whenever the credit first came out, the IRS said that employers are eligible to get a refund of $5,000 per employee. And so the way that they calculated this is, so for the entire year of 2020, if you paid a specific employee $10,000 or more, then they would qualify up to the $5,000. So the formula is, let's say you paid someone $10,000 throughout the whole year of 2020, multiplied by 50%, it gets you to the $5,000. And that's how they determined how much was eligible in 2020. Now, if you paid an employee less than $10,000, then you wouldn't be able to reach that $5,000 threshold. For example, let's say you paid someone $5,000 in W-2 wages for the entire year of 2020. 5,000 times 50%, $2,500. So that specific employee would only qualify for $2,500 of the employee retention credit. Then in 2021, the IRS amended the rules of the employee retention credit, and they basically said that instead of $5,000 per employee, we're going to bump this to $7,000 per employee per quarter. So, you know, in a full year, there's 4 quarters. So they said $7,000 per quarter, but it ends on quarter 3 of 2021. So quarter 4 of 2021 does not count. So the math kind of works the same thing. There's still this $10,000 threshold, but it's on a quarterly basis. So if you paid a single employee $10,000 in Q1 of 2021, instead of multiplying it by 50%, they changed it to multiply it by 70%, which is how you get to the $7,000. And again, that's per quarter. And if you didn't pay a specific employee $7,000, $10,000 in that quarter, then you know that $7,000 credit essentially gets reduced. So there's 3 quarters in 2021 that are eligible to get you to 21,000, and then going back in 2020, the eligible amount was $5,000 for that entire year to get to your $26,000 per employee. Now the calculation is a little bit complicated, and if you did receive PPP funding, as I mentioned, you still are qualified for the credit, but it would be reduced dollar for dollar by the PPP funding that you did receive. So that's also going to reduce the amount of credit that you could potentially get. So it's kind of like a brief overview of how the math works on the employee retention credit. So I think the next question that people might ask is, okay, well, how do I qualify for this credit? And so there are 3 ways for a business to qualify for the credit. And we can see the eligibility on this page. So the first one is probably the most straightforward, and that is the gross receipts decline. And so basically what a preparer needs to do is you compare specific quarters in 2020 and 2019 to 2020 and 2021. And you're looking at the gross sales of your business. And you have to determine if there is a decline in revenue, and there's a certain threshold. I believe it's 50% in 2020, and then there had to have been, I think, a 20% decline in 2021. And so you're comparing a specific quarter in 2019, for example, Q2 of 2019, and you compare that same quarter's gross sales to Q2 of 2020, and you say, okay, was there a decrease between 2019 and 2020 in that specific quarter? And then for 2021, you would do the same test. So you look at that same quarter two of 2019, and then you look at quarter two of 2021. You say, okay, did my gross receipts decrease? And then you would be able to determine where you qualify. And one thing that I did mention that I forgot to mention is that there are 6 quarters that you would be able to qualify for. And so taking a step back, basically the way that the credit works is on a quarterly basis. And so the way that you obtain this credit is, let's say you determine that you're eligible and you qualify, going back to the rules. The way that you would obtain this credit is that you would amend your payroll tax return. So we said that, to qualify for this credit, you have to look at your employee wages and your W-2 wages. And typically, if you're paying W-2 wages, you're filing quarterly 941s. That's the payroll tax form that you file with the IRS every single quarter. And the IRS came out and said, with this credit, there are 6 quarters that would qualify for the tax credit. That's Q2 of 2020 all the way through Q3 of 2021. So that time frame, those quarters are how you would qualify, and you would submit a 941 to the IRS for each quarter that you believe that you qualify for. And we can get to that in a little more detail in a moment. But I kind of want to circle back to the eligibility. So as I said, the 6 quarters that you can qualify. So with gross receipts, you're kind of analyzing these quarters to determine, do I qualify for a decline in revenue in those quarters? So let's say you met the test for 2 of the quarters only, and you didn't meet the test for the other 4 quarters. You'll still be eligible for the claim, but only for the quarters that you actually met the gross receipts test during that period. So that's kind of the gross receipts test. So you're comparing quarter 2019 to either 2020 or 2021 and determining that if your sales had decreased. So that's test 1. Test 2 is the full or partial shutdown. And now this gets a little bit more complicated, and as like a subgroup that we've kind of broken out into its own, it does fall under the full or partial shutdown, but it's the supply line interruptions, and you can see that is the third point. But we'll get into that in a moment. But I want to focus on the full or partial shutdown right now because, again, it's not very clear, and you'll want to make sure that you're dealing with someone that's an expert in this field that really understands what this really means. And so for a full or partial shutdown, for you to qualify for this test, there has to be 2 conditions that need to be met. The first one is the business operations were fully or partially suspended or shut down due to a government order. So that's condition number 1. Condition number 2 is the suspension had to have a more than nominal impact on your business. So point 1 is that your business was either fully or partially shut down, and point 2 is that if you were full or partially shut down, that full or partial shutdown must have had a more than nominal impact or a significant impact on your business. And so 3 ways to determine if you were full or partially shut down. There's 3, points. First point is the direct shutdown. So through a government order, your business was directly limited in the ability to do certain things. So think of, because of a government order, I could not do this. And so some examples of that would be restrictions on indoor dining if you're a restaurant, occupancy limits. If you were a service provider and you had to turn to appointment-only services, you had to limit your hours of operation, limits on any type of service format. So, those are going to be a direct shutdown order. So again, that is a direct shutdown. The government said, hey, you can't do this, and you were limited in your operations, and it had a significant impact on your business. The second one is a material modification. So in this example, if all of an employer's business operations could continue, so the IRS said, or the government order said, hey, you can still continue to run your business, but the operations are subject to modifications due to a government order. And so maybe there was additional sanitation that you had to do. Maybe if you had a dental office, instead of, let's say you had 10 chairs where you could see patients, you had to limit it to only 5 chairs. So it was every other chair you can use. And so you have to materially modify your business to accommodate for this government order. And so those are the two main ones as it relates to full or partial shutdown. And then the third one is supply line, which again, we have it on its own, just because it's a little bit more complicated. I think it deserves its kind of own category. And so to meet the supply line interruption test, an employer may have been considered to have a full or partial suspension of operations due to a government order if the business's suppliers are unable to make delivery of critical goods or materials due to a government order that causes the supplier to suspend its operations. So what does that mean? So think of it, if I'm able to dumb it down for you guys, a supply line interruptions, you want to kind of think of these three main points to determine if you qualify under a supply line interruption. And so these three things are the supplier, and all three of these need to have been met. The supplier cannot make delivery of critical goods due to a government order. So maybe the government order didn't affect you, but it affected your supplier. The business could not purchase those critical goods from another supplier, and the business must have experienced a more than nominal impact as a result. So number one is that your supplier couldn't provide you with those critical goods. Number two is you couldn't get those critical goods from another supplier. And because you couldn't get those critical goods, it had a significant impact on your business operations. And so with the supply line interruption, if you're meeting those three tests, then someone who's going to determine your eligibility is going to ask, okay, well, when did the supply line interruption start? So you'd have to provide a date. And you might ask yourself, okay, how long did that interruption last for? Maybe it was 2 months, maybe it was a year, maybe it's still occurring to this day. And so again, the credit is limited to Q2 2020 through Q1 of 2021. So if this supply line interruption is captured in that period, or if it went longer than that period, we'd be limited to the farthest we're going out is Q3 of 2021. Now, that being said, there is also, there was a third amendment to the employee retention credit. So we talked about how there was an initial one in 2020, you couldn't have the PPP funding, and it was limited to 2020 only. Then in 2021, they said, okay, we're pushing out this credit so you could be eligible in 2021, all the way through Q3 of 2021. Then there was a third amendment that basically said, if you're considered a startup recovery business, which means that you opened up your business after February 15th of 2020, and you did not incur any of these three examples, gross receipts, partial shutdown, or supply line interruptions, you could still qualify for some type of credit, and that credit bleeds into Q3 of 2021 and also Q4 of 2021. Now, that's only for a startup recovery business that didn't experience any of these things, and they had to have opened up their operations in February 15th of 2020. So I know I said a lot, and I'm sure there's probably plenty of questions. Jennifer, have we had any questions in the queue that people would like to answer before I continue?
I do have one that just came in. Marsha's asking, what about substance abuse treatment services being reduced?
So I think I would need a little bit more information on your question, but I have done a claim for a nonprofit that they were a rehabilitation center for substance abuse, and they did qualify for the credit because they had inpatients, and they only had they had a certain amount of beds, and they basically had to reformat their entire building to accommodate for the government order of COVID. So they had to have every other bed that was used. The rooms that they did have that were for beds were kind of just dormant, and they weren't utilizing them, and it had a significant impact on how many people that they could house in their facility. And so therefore they did qualify for the credit based on those circumstances. And that specific client actually received a significant amount of money because they did have a lot of W-2 employees on payroll. I hope that answers your question.
Absolutely, thank you. Another question we have is, one of our main staff is a sister of the owner on W-2 for over 20 years. Will she qualify?
So great question. So again, this credit is a very complicated credit, and you guys are asking all the right questions. And so when it comes to family members, the rule is that if an owner owns 51% or more of the business, then that owner and their family members, sons, daughters, brother, sister, mother, father, their wages would not qualify. But let's say that an owner owned 50% and another owner not related, own 50%, then their wages and their family members' wages would qualify for the credit.
Her follow-up is, what if they're the 100% owner?
So if the 100% owner has a sister that's on payroll, then the owner and the sister both would not be eligible for the credit.
Okay, perfect, thank you. The next question is, what is considered to be a nominal impact?
Yeah, so that's a great question, and the IRS has not been very clear on what the definition of more than nominal means. Because someone's perspective of a significant impact to their operations might be different from someone else, and I think you just kind of got to look at what is reasonable in a situation, and I think that it leaves a lot of open-ended questions, but then also a lot of room for argument and kind of persuasion, I guess, when it comes to the IRS and them determining, is it fair or not. So again, to really give you a straightforward answer of like, this is, what's more than nominal and this is what's not nominal, I think it's a very hard question to answer. And again, there's a few different metrics that you can look at it by. And so like I had a client, they were a daycare, and next door they had a park. And the kids would go and they would play at this park. And whenever COVID hit, there was a government order that said that you cannot use this park anymore. And so the daycare spent $40,000 to build their own play structure. And for them, it was a more than nominal impact because if you look at the amount of revenue that they had compared to how much that they spent, you could see that it was clearly a significant amount of money to that company. But let's say a company was in the same situation, and let's just say for the sake of the example that their revenues is $1 billion. They're $1 billion company, and they spent 40 grand on building this play structure. To me, in my opinion, I don't think that that's a significant amount to a business that is spending, is making $1 billion. And so I think it's all relative to the specific situations. And so I think as far as determining, what is a significant impact in the business and what is not, I'd be happy to give my input on the specific situation. If you want, I think at the end of this call, I'll have my contact information. You can feel free to reach out and we can talk a little bit more about that.
Absolutely, and yeah, I have a lot of very specific scenarios coming in the chat. So I'm going to maybe allow those to be taken offline. You can kind of like address those on the individual basis. So if you had a next slide to get to, Matthew, go right ahead.
Yep. So the next slide is our process. So at ERC Tax Pros, we are a firm that's dedicated to only filing employee retention credits. And this slide's a little bit older, so you see the first one is a discovery or initial intake. And so our first steps would be we would send you a questionnaire. And again, we've done over 500 of these claims, and so we've catered our questionnaire to kind of ask all the exact information that we need. So once this form is filled out and you click submit, we are able to determine if we believe that you would be an eligible candidate or not. And once we determine eligibility, we'll kind of send an engagement letter saying, hey, this is a service that we're going to provide for you. And once we get that executed, we will start to request documents. And so the typical forms that are usually required for either our firm or any type of employee retention credit firm to prepare the calculations are these 4, maybe you call 5 items. So the first one is the payroll register. So we need to be able to see each individual employee and their gross pay and their net pay by paycheck or pay period. And that's the kind of meat and potatoes of what we use to actually drive our calculation. And I know a lot of people, they kind of struggle with getting their payroll registers. And so, that's kind of the most important thing. And again, that, having that good data is crucial to us to make sure that we're getting you the max amount of credit for you. The next one is going to be the 941. So again, these are the quarterly forms that you submit to the IRS. And what we'd be doing is we are taking those forms to make sure that they match the payroll register that's being provided to us to ensure that the payroll registers provided to us are complete and that we're submitting accurate numbers to the IRS. Because I think that's one thing that you want to be careful of is, making sure that these calculations are done correctly, that you're not being under qualified or even overqualified. And so then the next item is the payroll, the PPP loan forgiveness applications. So you might have gone one round or 2 rounds, but again, with this calculation, that is a reduction of your claim. So we'll need to get the forgiveness application to determine how those funds are allocated and how we should properly allocate them in our calculation. And then the last item is the gross receipts of the business. So we would, kind of how we were talking about the first test is, comparing a quarter in 2019 to 2020 or 2021. And so getting that data so we can determine, did you guys meet those thresholds or not? Once we get that information, we'll put it, in our work papers. We'll have our accountants go prepare it, and then we'll determine what the credit is. We'll kind of send that back to you and say, hey, this is what we've determined to be your credit. Here's our work papers. Here are the 941Xs, which are the amended 941s for you to sign. And then once we get those back signs, we will mail those out to the IRS and then start to track the status of those refunds. And typically the refunds will come in the form of a check. And with this process, why you have to be careful is because with the employee retention credit, if you submit an amending 941 with the employee retention credit on there to the IRS, whether the information is correct or incorrect, the IRS is going to issue this refund. So the risk that you have to worry about is not if or when you're going to get the money. It's more so, is the IRS going to come back and try to take this money from me? And the IRS has published a lot of publications saying that they're what they call ERC mills, which is essentially like a sales firm that are targeting people and telling everybody that they qualify. They don't really have much either accounting or legal background. Like they're just more so a sales firm, and they're trying to bring people in, and they're charging a significant amount for them to prepare this claim. And so you just want to be careful of those because the IRS has been publishing, beware of these ERC mills. And they're also going on to say like, hey, even if you get scammed into dealing with one of these ERC firms that are misqualifying people, it's still your responsibility as a taxpayer to, if you did get misqualified, to pay back those funds to the IRS. So there is some level of risk and liability there when you're dealing with someone that probably isn't too versed in this and is trying to just kind of bring in as many people as you can. So kind of be wary about those because the IRS has, again, like I said, posted a lot of publications of hey, beware. And there'll definitely probably be some audits in the future related to these credits, just because I think there's so many of these firms going around falsifying these claims and telling people that they qualify for more when maybe in fact they did not. And so that's one thing that you'll get with us is, again, we have very in-depth work papers that we would provide to the IRS along with our basis of qualification based on the information that you provide us. And we can say, hey, here's how we qualify them. Here's our calculation to determine the credit. Do what you like with them. And we've had one audit so far that has gone successfully. And so I think we're pretty confident in our process. But yeah, so that's the initial process. Any questions on that?
We do have a question about that. Is there a minimum size employees or potential credit for you to accept a client?
Yeah, so good question. So there is actually a limit. So for us, it's 5 employees that are non-family members. So you have to have at least 5 employees that would qualify for us to take you guys on as a client. Good question.
Excellent, thank you. And then going back just a little bit, but can you define gross receipts? They say an accrual financial statement basis or cash basis as elected for 1120 tax filing.
Yeah, so I would say gross receipts is just going to be the total sales that you had in a specific quarter. So not net of discount or net of cost of goods. It's just going to be the total sales in that quarter. And as far as the question is it going to be cash or accrual? I would say there's not clear guidance on this, but I would say the safe bet is when we're assessing this, the way that we approach it is if you file your taxes on an accrual basis, then we would look at the calculation on an accrual basis. If you're cash basis for tax purposes, then we would evaluate the gross receipts or total sales based on the cash basis.
Thank you. And then I think that's it for this section of questions.
Okay, awesome. So we have plenty of questions, so I think we can skip this slide unless there's anything else. So our last slide is our contact information. Again, Jennifer has our contact information, so if you guys are interested, you can reach out to Out of the Box and they can make an introduction. And one thing I think I forgot to mention that I just thought about is some of you might be wondering, hey, how much does this cost? So typically we charge 20% of whatever the refund is as our fee, but in partnership with Out of the Box, we had a promotion where any clients that are referred to through Out of the Box, we are charging 15% of whatever the total credit is.
Excellent. I know our clients so far have really appreciated that. And so like I mentioned, there were a lot of people who chatted over just their specific situation. And so for that, I'm just gonna kind of link both of you up so that you can kind of talk through that and see how those specific business scenarios would apply and how they can kind of go through this process and figure out if they qualify. So
absolutely.
Matt, thank you so much. Honestly, this, as we were talking before we kicked off the webinar, this is something that I don't think a lot of business owners realized was out there, and clearly can be a game changer when it comes to your bottom line. So I appreciate you bringing this to the surface and just building awareness for not only our clients, but anyone who's watching this webinar comes across it. It's really super helpful.
Oh, no, my pleasure. I appreciate you having me on, Jennifer.
Of course. And with that, I'll leave Matt's contact up here just for a few more minutes as we close out. All of those who are watching, again, this is recorded, so I'll send that recording out to you in just a bit this afternoon so you can revisit anything. And if you have other questions that come up, you can definitely reach out to ERC Tax Pros, or you can contact your rep here at Out of the Box Technology. Again, we are really in close communication with Matthew and his team, and so we'll be sure to get your questions answered, get you through the process that you need to, and hopefully get you that incredible tax credit. So thank you all so much for joining us today. It's our pleasure to host this and bring this information to you. I'm sharing out our information as well. If you wanted to touch base with Out of the Box before making that leap over to Matt and his team. But thank you so much. We appreciate it, and we look forward to having you on a webinar again soon.
Thank you so much.